Good afternoon. It is Monday, December 14th, 2020. Stocks of the week. Kirk Spano, Margin of Safety Investing at Seeking Alpha, fundamentaltrends.com. And going to go through our plug and play portfolio here a little bit and look at some charts, talk about one of our indicators. So one of the things I talked about this week was relative performance. In general, given a basket of stocks, say the stocks within an ETF, you want to own the ones that perform relatively better if you're going to buy stocks individually. So we looked at utilities last week and the week before, and people were talking about, I like this utility because of the dividend and for this reason or for that reason. Ultimately, if you just look at the performance over the last 1, 2, and 5 years, typically you will be able to identify the better performers. And unless the market changes its opinion of something, usually those will be the same stocks to own in the next 1, 2, and 5 years, unless there is some deeply embedded value in the ones that have underperformed in the recent past. Again, I use 1, 2, and 5 years. I use 2 years because that is a fairly typical cycle. You can look at 3 years as well. In the charts today, we'll be looking at roughly 2+ years. We can go back 5 years, the 2015-16 period, because that was the last time that we really had sort of a stealth bear market. Essentially, the market's chopped along sideways for 2 years, allowing consolidation to occur and to create that spring component when there were catalysts applied. The catalysts that were applied were tax cuts and deficit spending, and then a ton of money from the Federal Reserve. And one of the things I'll be talking about in the Macro Monday article this week when I get it up. Last week I missed, I just fell too far behind. This week I will work on it tonight and tomorrow morning. Is that the narrative about what really pumped the stock market up, now that we have numbers from a number of different sources coming in, appears to be wrong. It really wasn't the Federal Reserve that pumped the stock market up from its low into that first rally into late May, early June. It was foreign investment. And I talked to you about foreign investment back in April because I had 5 new consulting clients from abroad, London, Israel, Dominican Republic, and a couple of other places where the investor said, look, my family has X millions of dollars over in this country and we want to get it into the United States. This is a good time to do that. And a lot of the money market money is in fact from people in different countries. They went into the stock market early and have been slowly selling off ever since. Now, the Federal Reserve is probably the reason that we have the stock market floating and drifting up, but that wasn't the initial big jump the first 2 months. That was really foreign money, which accounted for on net all of the new investments into the stock market. If these numbers that I'll be showing you in the Macro Monday article are correct, which I coached from a pretty smart guy. So we're now looking at the Federal Reserve having a little bit less firepower coming into the new year. And we're also looking at a major S&P 500 rebalance with Tesla jumping up into the 9th or 10th or 12th, one of the highest spots in the index, meaning that pretty much all the companies below it are going to take a little bit of a hit on inflows as the S&P 500 rebalances, kicks one company out. Interestingly, when a company gets kicked out of the S&P 500, because it was already small and receiving very little from the S&P 500 indexes, oftentimes they'll receive more money by being the biggest stock on the mid-cap side, or one of the biggest stocks on the mid-cap side. So where do companies start to really feel less impact, a negative impact from lower money flows? It's when they're heading into the bottom part of the S&P 500. And a number of companies are going to get forced down a little bit because there's a lot of selling that has to take place at the end of this week to accommodate Tesla getting added into the S&P 500 a week from today. So Friday could be a pretty interesting sell-off day is what I'm telling you. Let's take a look at our plug and play list. And this video will not go on the public side. So this will be behind the unlisted paywall. So I will give you the link and you have to visit it from your subscription because it will not be on the YouTube page that's visible to the public. Take a look at the relative strength index. You can see that a lot of stocks are finally starting to get close to oversold, but none of them really are oversold as of yet. And when I show you the charts, you go, oh, I can see what that next leg down could be. So let's start with Alibaba. And what we can see here is that if it has big support underneath it, right? There's a fib level right there. And we can see that there is a lot of activity in this price zone. But this is a low volume area, meaning that it could be pretty easy to fall through here, get all the way down to the 220s at the 618 level. So I told you I have orders in for Alibaba at 230, and then I have another set in at about 210. And I would really back up the bus if it got into the 180s. Chinese government is picking on them right now. We can see going back a couple of years that this is really a big consolidation zone in here. So this is probably where you want to buy the stock, unless you think it's going to break down even further, which is possible, but I don't think very likely, given that it's a very fast growing company. So you're just at the very top of this buy zone. And I already took one starter position right in here, right? I did it back over here. It's back, so I'm back to even on Alibaba with today's drop. And we'll see if it drops down here to 230-ish. If it does, I'll probably add to my position for the accounts where it makes sense. The other thing that I could do is instead of buying Alibaba, buy EMQQ, which is the ETF that invests in companies like Alibaba in emerging markets. Again, at about 53, 54, it starts to look attractive. At about 50, you've got this high volume zone, and if it doesn't hold, I should probably put this all the way down here. And you could probably see getting this in the 40s, middle 40s, before high volume kicks in again. This is a line that I drew last week, basically saying, imagine if we hadn't had this crash, where would this be right now? So if we connect this peak, which is right before it turned up, actually we want to connect this peak. This is after it turned up. Match it to about there, that peak, then just extend it. So again, if you look at that, you connect your peak after it started to rise, right? New trend. So grab the first peak and then go to the next peak after it drops, consolidates, comes back up, test it again here. So that's a pretty good trend line. And really these trend lines should be a little bit curved, but because it's a short time frame, we don't bother. You see that, look at that. Right in here, that would make a lot of sense. So I would think that we could see middle 40s on EMQQ. Right now it's still around 60. That's about a 25% drop. This area up here though, I think you have to take your initial position if there's not a crash going on, because we can see off a lot of consolidation buying in here. So it popped up, hit resistance, looks like it's going to head down. It gets into this area. Again, probably add a little bit of position. I added just a little bit up here because I thought it might break out, but now I'm regretting that a little bit, but it's a small position. So I'll add in here, I'll add in here, and if we get some sort of Armageddon scenario, down in here. Nvidia, everybody's very interested in Nvidia. One of the best stocks in the stock market the last decade. It's been jitterbugging in this no man's land. Probably ripe to fall below 400 would be my guess. It's a pretty big drop again. Another 20-something% drop. And it could drop, it's not hard to see this one dropping 50% if there's a double dip recession especially. So still not sure where big support is here. Over the last 2 years, it looks like it would be in here. So if we were going to put another box, our preferred buy zone, you see that candle right there? I'd say probably here to here, all the way down to that confluence, probably be our preferred buy zone. Now, things with Nvidia to think about are this. What if that purchase that they just made, I forgot, I don't even know who they bought right now, but they just bought a big company. What if that's a sign of weakness, not strength? A lot of times, companies will use their inflated currency to buy somebody because they know that in a year or two, they're going to need some help. I'm not positive where Nvidia stands against the competition right now. I'm sure that purchase was important. And if we get a pullback, I think Nvidia, as one of the best AI stocks out there, is something you have to buy. Now, is this jitterbugging going to stay up here and then just have a new breakout? I don't think so. I've looked at the numbers enough to know that probably it has to come back, but it's very difficult to believe that a stock will drop 50%. Everybody hates that idea. You know, it's visceral to a lot of people. You know, if we extend this to here and call that a top, if we discount the coronavirus crash, coming down into this price range doesn't seem all that far-fetched anymore, does it? Because the stock almost never corrects, it's hard to figure out where to put. I mean, this is like Microsoft, right? I called Microsoft the beast. Where really are these correction zones? It's hard to find it. So let's decide, right? Let's make a decision that Nvidia is a special stock and that it just doesn't correct very often or very much. In that case, now all of a sudden you have a buy zone in that 350 area, maybe all the way down to 300. That type of correction seems to make a lot more sense. Now, would this buying pressure, this is a high volume zone, would it push up, right? Because other people can see this too. The Traders Academy that I talked to you about, right? Online Traders Academy, they use this type of a measure to look where the buy orders are sitting. My guess is that this is a desirable company to own, unless something bad is going to happen, that these high volume areas are going to move up. And that this area right here, from the 618 fib to here, again, and we drew our fib by not including the coronavirus crash, just presuming that was a disruption that you can just kind of get rid of because it's an event. You say, okay, now it's jitterbugging up here. That looks like a top. How far down is it going to come? Well, if that's our turning point, that's our top, then these are pretty standard lines there. And you say, okay, look at that. Here's a low volume zone right above a high volume zone. And could this high volume zone move up a little bit? Could people decide to buy in here? I think that's probable. So for me, if I see Nvidia getting to 350-ish, I'm going to be pretty excited about buying. And that's still a pretty big correction. I'm going to save that chart because I like that chart. Suddenly, I like that chart. Amazon, jitterbugging. How far down can it come? Hard to know. Should we look at a shorter time frame? So in here, pull up the 5-year chart, condense this a bit, go all the way back to where this rally started. You say, okay, does this matter anymore? This period from 2015 to the corrections of 2018, do those matter anymore? We don't want it to matter, right? We don't want to believe that we can go back to 2015-16 prices. And I believe that since we've printed so much money, that probably we can't. But I think the triple bottom of the 2018 and the coronavirus crash, I think that could happen. So let's throw out these super long-term fibs. Just remember in our back of our head that we can always go back to the 2015-16 stealth bear market, right? The 2 years of moving sideways. So call that the top. Where are we now suddenly with this stock? See all this heavy volume here for the last 2 years? I think that this box is pretty legit. Could we go, right? The reason this was here, because that's a one line, and there's some jitterbugging right over here. Right? It breaks through there. Then it breaks through that one right there. So this zone here, this 1800-ish to 2400-ish, zone for Amazon seems to be the place to go. Obviously, 1800-ish would be lots of bad things going on, and 2400-ish would be, that just looks like your run-of-the-mill 20-30% correction. So let's save that. Pulte. Here's another one. Doesn't matter what happened way back here anymore. I think for our purposes, it probably doesn't, but we should remember in the back of our head, what about 2015, 2016, right? Where's this bull run start? Starts right about there. Housing's a longer cycle, so let's think about housing as a longer thing. Let's go back to 2015 with the housing cycle. That gap right there started right away with the coronavirus crash. But what if we throw that out and move sideways? What if this chart had just been jitterbugging all along, all year? Then how would you feel about Pulte if it didn't have that right there? Just fill that in. Imagine that the chart was going sideways like this. What would you be thinking? Are you thinking if it goes like this and then starts to break down, that it's in for a correction? And if so, where would it get? This top right here seems to make a lot of sense. In fact, I think we could probably move this up to here. But this 618 line makes a lot of sense. This is our primary count. We take a look at where some of these lines are. For sure, this 618, I think, is probably important. Right above a high volume area. So again, even if the coronavirus crash, it caught right in there. It bounced off it here in 2018. So if we get a big correction, could it get down to here again? For sure. I'd be buying it a little higher, probably at the 0.5, all the way up to this correction zone right there with the 618. And again, you want to make sure that you're looking at where is the big volume. So right about here, right, low volume, so easy to go through low volume, the volume starts to pick up. So where it stops in this area, I think really depends on just how bad things get. And really everything's pointing towards a double dip right now, unless they do a stimulus package. But even that $1 trillion is going to be tough, especially if it doesn't include money for people to pay their rent. So that would be your upper price target on Pulte, 70 something, presuming they, the market likes them and they actually earn the money that I think they're going to earn because of people building new houses. And the thesis behind people building new houses is pretty simple to understand. There's a shortage of single family houses. A lot of the boomers can't afford to move, so they're holding on to their houses even though they're too big. And there's probably going to be a lot of immigration in the next 4 years. So you'll get immigrants who are looking for lower end places to live. Some of them are going to spend a lot of money, but you're going to get millions of people who are at the starter home level or renting. And then as the millennials move out to the burbs and the school districts that they want to be in with their kid or kids in some cases, a lot of single child homes for millennials. You'll see them go out there, and I think a lot of them are going to try to build. I know that a lot of Xers are looking to build. So Pulte should do pretty well. People like the semi-planned communities, right, where you have some amenities in the community, and you're willing to pay a small homeowners association fee, so that you don't have to do certain things. Not like a high rise where you're paying a fortune, but $200, $300, $400 a month to cover a lot of the outdoor stuff and maybe security. So I think that Pulte, it gets down to 30 something. You really have to look at it, and it's close, right? That's 37 right there. I get down into the 30s, even the upper 20s, mid 20s. I don't think Pulte's that far away from being pretty attractive. Berkshire Hathaway, a complicated stock because they own so many things. We know that Berkshire Hathaway's been buying back more shares. It's just about down to the top of our buy zone. Sure would like to get it really close to 200. For sure, I'm going to have to buy a lot of it at around 200 if it gets there. Why? Because they're sitting on a mountain of money and they're not being shy about buying back shares. And it's a way for us to get some exposure to some of those Japanese stocks, some of the other things that he's bought that maybe we just don't want to bother holding ourselves because it'd be hard to manage. So this basket, I look at this as similar to QQQ, different holdings, but similar concept in that it's just a better index than the S&P 500 right now with their operating companies, their insurance float, and their insurance companies stand to make a lot of money in coming years. Buffett was talking about that recently. So this should be very high on your list because even though it hasn't outperformed, right? This is not the relative performance play. This is the incredibly deep value play. And they got a mountain of cash to buy back their own shares. So there's limited risk. Over on the dividend side, Barrett Gold is still looking awfully attractive. If it gets down to 20 and upper teens, I think you just have to, you need to make this a very full position. And I personally think it can be a double position. I really do. I just think that when you take a look at what's going on here, there's very little reason to think that the gold stocks are going to have a problem. They're earning a lot of money. And that's different than buying gold, which might be choppy and in a range between 1,600 and 2,100 for a while. Ultimately, I do think gold breaks out to 3,000, but it might not be next year. It might be 2, 3, 4 years out. In the meantime, these companies are making a lot of money. And again, let's pretend the coronavirus crash didn't exist. And let's bend this backwards. Whoa. Now all of a sudden, got a much higher target price. So what if we play with the timeline like in Star Trek? You have a prime timeline, then you have a Kelvin timeline. Yeah, that's right. One of you nerds out there gets that. Now all of a sudden, if we use this high and we use a previous low, whoa, what does that tell us? Well, interesting, some of these lines match up. Look at that, right? Look at that. Confluences. So sometimes you got to think a little bit outside the box. I think this has a lot of upside. But could it get back in this box? For sure. And if it does, gobble it up. So what you're seeing is that I am starting to just throw out the coronavirus crash. It's not counting anymore. It didn't happen. Just pretend that all the stocks chopped along during that time period from March to August when they recovered fully. Chopped along. Just pretend that was a chop from here, February to May, right? Pretend there was 3 or 4 months where it just chopped along instead of making that funny shape. Broke out, came back, broke out, came back. So I think you definitely can be buying this right here. I can pull this back to the 0 line and say, now that makes it even more sense, right? Came back to this area, came back to this area. Will it go down a little bit more? Will there be more pressure? I don't know. But I think you can almost have this be a full position right now. If you don't, and your first position is somewhere in the low to middle 20s, then you wait a little bit to add to it. See if this follows through, because it looks like it's going to follow through down to 20-ish. I can pull this up, actually, because you always like to look at where the confluence of lines are and where the high volume starts. Home Depot. Let's fix this chart too. So I actually look like I have this one about right. Let's throw this out, shorter time frame. Let's just do 2018. So where does the uptrend start? Right there. Make that our green line, which is our primary. Say okay, went there, there. Then let's do something weird here too. Let's grab that high, go back in time to that low, which corresponds to a jitterbug range, right? Look at that. That low corresponds to that jitterbug range. This actually just makes so much sense to go all the way back here to 2016. Pull the yellow box over. Say, okay, where can this one get to? That just makes a ton of sense right there. Oh, look at that. A 0 line. It kind of represents the start of something. Look at these jitterbugs in here. So Home Depot, unless you think something really bad is going to happen, I think we go all the way back to 2016 on this one, just for you to see that it got almost there, got almost there, got almost there, and then finally broke out. So I think that's probably around 140, about as low as it can get to. I'm not saying it will, just saying if really bad double dip things happen, it could. But I think that this 200-ish range right? It got up to here, fought with it, got up to here, fought with it, finally broke out, came back, tested it. Coronavirus crash, blew up everything, but then again, it held down here, broke through. Let's just pretend this is the turning over. This is the turning over area. You can see that it could be developing a head and shoulders, so we'll see. So if you're a dividend investor and you like Home Depot in general, and I do, that's why it's on the list. And it's not just a Dow stock, but it's something that I would put on my dividend list. Great balance sheet, great business. Not really a ton of competition. You got Lowe's and then you got regionals. Wisconsin, it's Menards. I know there's a big one in Texas and Arkansas and Oklahoma that Berkshire Hathaway owns. Oh, another Berkshire Hathaway in a good spot. So I think this goes right there. 220 something. I think you really got to start sniffing. And right around 200, I think, is pretty brilliant. Right, where's that 618 line? That's the 618 line. And a confluence of that. Yeah, it's interesting, right? It's interesting. All right. Make sure you're checking your RSI. Your dailies kind of give you a heads up. Then when you come back to these charts, take a look at your weeklies. And even though Nvidia is jitterbugging right now, still has quite a way to go on the weekly RSA, right? This was the coronavirus crash, but people are anticipating, oh, well, now that's going to be good for tech. So I would think that for sure it can get to here if we have a double dip recession down in here. And I think we might get a couple of bad quarters here, first and second quarter maybe. So how will the market react to that? Hard to know. How much is the Fed really helping? We now know that it was the foreigners at the front end, foreign direct investment. And that money's probably going to stay here because they were trying to get it out of where it was. And they're looking for an opportunity. That crash was an opportunity. A lot of that money's flowing into bank accounts now that they've made some money in the stock market. And I'm talking to people who are telling me that, hey, we bought QQQ and now we're selling QQQ. We're putting the money in the bank. And that's why I've said the last couple of weeks, a lot of that bank money is not for the stock market unless there's a pretty good correction. It's not just going to trickle in to push things up and up and up and up. No, it'll come in on volatility. So I do think there's an ultimate floor to the stock market. Probably in the low 2000s on the S&P 500 is about as bad as it can get. But we've looked at charts week after week that also tell us that right around 3,000 on the S&P 500, right, and into the 270s. I think we should probably bring this up. I think that's probably your buy zone. Right? And that just happens to be a 618 line. Didn't know that until I traded it over. So from about 300 on the S&P 500 on the SPY, 3,000, low 3,000s on the S&P 500 to the 2,700s, that's probably your primary buy zone. I mean, look at where all that jitterbugging takes place. It finally breaks out, blasts through it, right? A lot of these charts are the same. Goes through it, it's hitting resistance, having a hard time going through. So could it push through to 400 on the SPY, 4,000 on the S&P 500? Absolutely it could. If it broke through the trend line, then you know it's going to come back. Either that or it has to wait for the trend line to catch up, and that takes time. So could there be another 10% up? Absolutely. Is there likely a 20 to 30% correction coming? Even more likely. Now that it's clear that the market just wanted to discount this. Got the foreign direct investment in here. You got the Federal Reserve kind of chopping things around up here. You have the margin. You have the call buying. At some point, valuation matters. Somewhere along this trend line, this alligator jaw, right? Somewhere in here, valuation matters. And then you get a reversion to mean. We know that we're in a third standard deviation for valuations. It needs to come down in here to be close to fair value. I mean, this is really close to fair value. It's not quite fair value. Fair value is actually down here. But when you adjust for low interest rates and people not knowing what they're doing, it's probably up here. All right, that's all for tonight. I will get this edited and posted soon.